Hello, it is the 24th of November 2010. Welcome to today's silver technical analysis. And I've been hearing a lot of people talking about silver caving in and a double top formation. And I was actually expecting this to kind of happen because I would be expecting people to ignore what happened during this break above the 28 level, and B, for people to ignore that we have yet to even complete it because we really got to break this neckline of 25. A double top formation pattern is when you make a two levels of resistance that are roughly in the same area and have two levels of support that are in the same area. So that has not been the case because this high is significantly lower than this high, and we haven't even came close to coming down to this neckline of 25. Now, if it does come down to the neckline of 25, instead of being a double top formation, it will be that of an inverted cup and handle formation, something like this, and it's very close to a double top. Instead, it means it makes a lower high instead of a even high from the previous level. But with that all being said right now, what we can see on the charts is that it came down to 25, and I was saying at the time to expect a bounce because it was Fibonacci from this high and the lows back at around $18 per ounce. So it found its bounce. It started to make a pattern of higher lows and higher highs. That's a definition of trend. Higher highs, higher lows, or lower highs, lower lows. So it's been in a bullish trend because of this. There's a rising 5-day moving average. It has not been tested on SLV as of yet. I would still like to see a test of that area. So a break of this trend line would not be a major problem. In fact, right now it looks like it wants to break the trend line. It's making these lower highs on the short-term level, and it's been testing the support level now yet another time. I wouldn't mind seeing a break of that trend line down towards the 5-day moving average, down towards this volume weighted average from this high, because now that this volume weighted average is rising, since the market topped out back at 29 1/3, the buyers are in control because it is above a rising volume weighted average price. This 10-day moving average, you can see is declining, and that's more of a formality more than anything, because what's happening is it's eliminating the previous results with these big ones in here. And so give it a couple days, if not even just another day. As long as it can hold above 27, that moving average will be rising. You have a rising 20-day moving average, rising 50, and not shown on the screen, you have a rising 100 and 200-day moving average. So to say that the sellers are going to take over control, to me, just means that you're guessing, or you have fundamental information that I don't have, because the technicals sure as heck do not say this at all. Now, if we do some Fibonacci from this 25 level up towards a 28 high, first we'll do 25 to 29.33. This level here of 27.60 to 68 was the 2/3 Fibonacci level, roughly in towards here. So Fibonacci has been resistance. If it is successful, then it's either going to come to this level, sell off, and maybe come down to here, or it may just stay within that area and correct through time. So thus far, it's been a correction through time. This week, it's been ranging between 27 and 28, very choppy and less volatile, which I think is healthy for the market to be able to get away from the volatility that encountered when we had the big selling earlier, that is. Now, if we take this Fibonacci from the recent highs, and it's been about 27.95, I think it got up to. It doesn't make much of a difference anyway which number you put there, but we'll say 26.80 and 26.10 as some significant levels. So right here at 26.80 is pretty massive. You got the 10-day moving average. It would be a pierce below the 5, and then you also got this 26.10. As long as it can stay above these levels, then there's no reason to say that it is bearish. Anything above here is bullish. Anything below here intermediately would be bearish. So bearish here, bullish above here, and neutral within this gap also. Now, the final indicator that I want to go over is that of a curve function, and you can give whatever name. Maybe there's another indicator for it. I don't know. But what I do is there's a function on MS Paint where I can use the curve, and I draw a straight line from a significant high to a significant low. And now what I'm going to do is I'm going to drag this over and make a straight line, as straight as I can get anyway, and give it some distance room like we see here. And what this gives me is the correction and what's going on within the correction. So as the market's going higher, if it can manage to get above this line, then it's looking to break the trend, which has happened. Now, if it breaks this line, it would continue its trend of a downtrend. So it's gotten above this level, and the secret is the 61.8%, because if you break 61.8%, that means the previous move becomes a failed move. Thus, if it can get above this 2760 area and maybe hold above it for more than about 4 or 5 hours, then that would make this a failed move, this entire selling. So therefore, for this rally to be a failed move, or the most recent rally from 25 up to 28, it really needs to break below the 26 barrier and then hold below there for more than 2 or 3 hours to say that this is a failed move. So therefore, with all of the action we've seen over the last so many months, the buyers right now are still in control. I'd like to see it come down on this 5, but what I want to see very rarely, or at least doesn't always, come into play. Thank you for watching.